Hey traders! Want to know how professional investors anticipate market shifts? It all comes down to recognizing chart patterns. These formations are the visual representation of supply and demand, and today, we're going to break down the four most critical categories, continuation and reversal patterns, for both bullish and bearish scenarios. Let's start with bullish continuation. These patterns form during an existing uptrend and suggest that after a brief pause or consolidation, the upward movement is likely to resume. They essentially represent the market taking a breath before moving higher. The triangle family, ascending and symmetrical. The ascending triangle shows buyers are getting stronger at a consistent resistance level. A bullish symmetrical triangle shows both buyers and sellers losing momentum equally, but the existing uptrend often wins out. Wedges and flags, the bullish flag and wedge are short-term, strong consolidations. When price breaks out above the pattern's resistance line, that's your entry signal, confirming the continuation of the trend. Always place your stop loss, SL, just below the pattern's low for risk management. Next, we have bearish continuation patterns. These occur in a downtrend and tell us that the selling pressure is set to continue. Similar to the bullish side, we have the descending triangle, where sellers are aggressively pushing the price lower against a stable support level. The bearish flag and wedge are brief bounces within a strong move down. The entry is triggered when the price breaks below the pattern's support. The core idea here is waiting for the temporary counter-trend move to fail before joining the dominant downtrend. Now, the most exciting part, reversal patterns. These are crucial because they signal a complete shift in market direction. Bullish reversals like the double bottom and triple bottom form after a significant downtrend. They show that sellers have tried and failed multiple times to push the price lower. A move above the neckline, the high between the bottoms, is a strong entry signal for a new uptrend. The inverted head and shoulders is another powerful bullish signal, representing three distinct lows, with the middle one, head, being the lowest. This is one of the most reliable reversal formations. Finally, we have bearish reversals, indicating a top is forming and an uptrend is about to fail. The double top and triple top show buyers failing repeatedly at a high resistance level. A breakdown below the neckline signals a strong potential downtrend. The classic head and shoulders pattern signals a distribution phase. The failure of the right shoulder to reach the height of the left, and the break of the neckline, is your cue to prepare for a significant drop. Mastering these 16 patterns is foundational to technical analysis. Practice identifying them on your charts. Don't forget to like, subscribe, and hit that notification bell for more trading insights.